Today, I want to talk about three topics that almost everyone misunderstands. In fact, a lot of financial advisors get these topics wrong as well. But first, my name's Kevin Lum. I'm a certified financial planner, and this channel is dedicated to helping 1 million people retire without worry. When I first started the channel, I agreed to do free retirement strategy sessions for anyone that reached out. And I ended up doing hundreds of retirement strategy sessions, which honestly became overwhelming, but it was also a great experience because I had the opportunity to review hundreds of retirement plans. And what I discovered in many of these conversations is that there are three issues or three topics that people consistently misunderstood, often to their detriment and to the detriment of their family. So let's dive in. The first thing that people misunderstand is the gift tax. I once had a person reach out to me who'd given her son $50,000 for a down payment on his home. Then she panicked, thinking she was going to owe taxes or her son was going to owe taxes on this gift. And I kept hearing a similar story over and over again during those retirement strategy sessions. I kept hearing some variation of, we're giving money to our kids or our grandkids, but we're being careful not to give over the gift tax limit. And every time I heard this, I would scratch my head and ask, what gift tax limit? And people would reply something like, you know, how you can't give more than $17,000 a year or $18,000 a year without triggering the gift tax. And what I realized was that people misunderstood the gift tax exclusion. So here's how it really works. If your estate is over a certain size, you have to pay an estate tax or a death tax on the value of the estate over that limit. In 2024, that number was $13.6 million for a single filer and double that amount for a married couple. So a little over $27 million for a couple. That number is inflation adjusted. So in a few years, it's going to be over $30 million. So if your estate is over that amount, your heirs are going to have to pay tax on the estate over that value. This, by the way, is why so many ultra-rich people end up jumping through a lot of hoops to try to avoid these taxes, because an estate tax or a death tax can be quite steep. And historically, when those limits were lower, it was especially problematic for family-owned businesses or family-owned farm. What would end up happening is you had a family business that was worth $5 million, but there wasn't $5 million in cash, and so then they'd end up having to sell the business or take out a loan just to pay the taxes. Luckily, those limits have been raised to help avoid those issues. So let's get back to the topic of the death tax. So if you have a death tax and you're quick thinking, what do you do before you die? You give all the money away, right? So that way, when you die, then there's not any money in the estate, then you don't have to pay a tax. Well, the IRS, as they always are, were one step ahead of you. And they said, no, you have to add up every gift you've given throughout your life, and then that amount gets added into the total estate. So if you give this kid $100,000 and this kid $200,000 and another kid $300,000, you've given $600,000. So then when you die, what they do is they add up all those different gifts you gave away and the current value of your estate. And as long as it's under the limits that have been set, you don't owe an estate tax or a death tax. Does all that make sense? So what does this have to do with the $17,000 or $18,000 gift tax that everyone talks about? And by the way, that number is always a little different in each conversation because it's pegged to the rate of inflation. So depending on the last time you checked, you have a different number in your head. Almost no one knows what the current rate is. So what is this gift tax limit that everyone is talking about? The $18,000 limit, or it was $18,000 in 2024, the $18,000 limit is the amount you can give to one person each year without having to file a gift tax return. Essentially, a couple can give $36,000 a year to any person, any kid or whoever, without it counting against their lifetime limit. So if you're under those amounts, you don't need to worry about these gift tax limits. If you go over that limit, you don't owe taxes. You just need to report it to the IRS. The IRS keeps track of it. They keep a tab throughout your life, and it gets counted towards that lifetime gift and estate tax exemption, which, like I said, in 2024 was $13.6 million for a single filer and a little over $27 million for someone who's married. The form you will file, by the way, so if you say give a $100,000 gift to a kid to help them buy their first home, the form you're going to file is IRS Form 709. Nobody owes any taxes. No one's going to pay anything out of pocket. It just goes against your lifetime tab. One last note. That exclusion limit, which is actually 19,000 as of this recording in February 2025. I kept using 18,000 because I'm used to the 2024 number. 19,000 for a single filer, 38,000 for a married couple. That is a per person exclusion. So let's say you have 10 kids and you give each kid $38,000. So you gave away 380. That stays below the exclusion limit. And that can be for anyone. You just give random people $38,000 as a couple and you stay beneath that gift exclusion limit. So I wanted to just make that clear because that can also be a bit confusing. Here's the bottom line. For the overwhelming majority of you watching, you can give as much as you want, but amounts over the limit must be reported, but they're not taxed unless you exceed the lifetime exemption. Okay, let's go on to the next topic. The next topic is the 5-year Roth IRA rule. A lot of people get this wrong, and a lot of financial advisors get this topic wrong, partially because there are 2 Roth 5-year rules, and they are slightly different. The first 5-year rule says you cannot pull out earnings out of your Roth until the Roth has been opened for at least 5 years. So as long as you have a Roth IRA that you opened, even if you put $1 into it 10 years ago, you meet that limit. The clock starts ticking with your first Roth contribution. So if you're thinking about doing Roth conversions or whatever, you want to go ahead and open up a Roth IRA right away and just put $1 in there. Just put some money in there. And once you put that money in, that clock starts ticking for that 5-year rule. So that's the first 5-year rule. The second 5-year rule applies to Roth conversions. Each Roth conversion has its own 5-year clock. If you convert a traditional IRA to a Roth IRA and withdraw that money too soon, you could face penalties. So let me walk you through a very simple chart to help you understand these rules. So first of all, let's look at contribution. You can always take out your contributions that you made to a Roth IRA, penalty-free and tax-free. When I was young, I didn't have enough money to contribute to an emergency fund and a Roth IRA. So I put my emergency fund into my Roth because I knew I could always take out the principal, my contributions, if I needed the money. Was it smart? Probably not. But it let me start getting more money into a Roth early on. And since this was before you had a Roth 401k, it was hard to get a lot of money into a Roth IRA. And so I just want to get as much money as I could into that Roth, knowing that if I needed the money, I could pull it out later. So you can always withdraw your contributions at any time, tax-free and penalty-free. The second thing is on Roth conversions, there's no tax and no penalty if it's distributed after 5 years. And each Roth conversion, by the way, has its own 5-year clock. So each time you do a Roth conversion, it starts a new 5-year clock on each of those conversions. So there's no tax and no penalty if the money is distributed after 5 years or after 59 and a half. So if you're over 59 and a half and you're taking money out of your Roth conversion, you don't need to worry about the second 5-year rule. This is what everyone gets wrong. So you do need to have a Roth open for at least 5 years if you're going to take earnings out. So you needed to open up a Roth at some point in your life, but it does not have its own clock. You just need to have a Roth open and put $1 in it. But on the conversion amounts, there's no tax and no penalty if it's distributed after 5 years or after 59 and a half. Now let's talk about earnings. There's no tax and no penalty if it's distributed after 5 years. Remember that 5-year clock, and 59 and a half. If you understand this chart, you will understand more than most financial advisors. Was this helpful? Was this more confusing? Let me know in the comments. And if it was too confusing, I'll make another video trying to make it more simple. So let me just quickly recap this chart one more time. If it's a contribution, you can pull the money out anytime, no tax, no penalty. It doesn't matter. There's no rules. If it is a Roth conversion, you have to wait 5 years or be 59 and a half before you can pull the money out. If it's earnings, meaning you made some money on that Roth, you have to meet the 5-year rule, meaning you had to have opened up a Roth IRA and put $1 into it at some point, right? So, 10 years ago, you put $1 into it, didn't really do anything. It didn't start funding it until later. As long as that account has been opened, it does not have a separate 5-year rule, and you're over 59 and a half, you can take out all the earnings completely penalty and completely tax-free. Hopefully that clears up some of the questions you had around it. And if not, I failed miserably and I'll make another video about this topic. So the next topic is the Social Security earnings limit. So I had someone reach out to me who had started taking Social Security at age 62 and was also working part-time. And she freaked out when her first check arrived because she was expecting $1,500 a month from Social Security, and it was $1,200. Honestly, I can't remember what the numbers were. And so she was like, what's going on? Now, most people have a basic understanding that if you start working while receiving Social Security, it can reduce your Social Security benefit, but they completely misunderstand how it works. Here's what you need to know. If you take Social Security before your full retirement age and you still work, there is a limit on how much money you can earn before your benefits are reduced. In 2024, that limit was $22,320. So for every $2 you earn above $22,320, Social Security will withhold $1 from your benefits. So for easy math, let's say the limit's 22,000 and you earn 30,000, so you earn 8,000 above, $4,000 of your Social Security benefit are going to be reduced. But, and this is important, once you hit your full retirement age, that earnings limit goes away. So you can make $1 million a year and you still get your full Social Security benefit once you hit your full retirement age. And here's the second piece, and this is what people miss all the time. Any benefits that were withheld, so that $4,000 that was withheld in my hypothetical scenario, you don't lose those benefits forever. Social Security recalculates your benefit and increases your monthly benefit later to make up for the benefits that were withheld. Now, I'm always nervous that they're going to get it wrong and I'm going to have to call and it's going to be a huge mess. And so I typically try to avoid taking Social Security while working. But if you do continue working while claiming Social Security before you reach your full retirement age and you earn over that earnings limit, you are supposed to get that money back when your benefit is recalculated later on. Does all that make sense? So if you take Social Security before your full retirement age and you still work, know the earnings limits, but don't panic if your check is reduced. You're going to get that money back later on, even if it could be a bit of a hassle. I just don't trust the government to calculate it well, but you will get that money back. So let's just recap quickly what we've talked about. First, on the gift tax limit, it's about reporting. Remember Form 709, not about owing taxes. Most of you watching, it doesn't really matter unless you are an ultra high net worth person that's going to have a very large estate. Or the other option is if the estate tax limit gets greatly reduced, then maybe more people have to deal with it. But most of you watching right now don't need to worry about the gift tax limit. Second, the Roth 5-year rule. There are 2 5-year rules. I'm not going to recap them here. Go back and rewatch that section. And then third, Social Security earnings limit. It's temporary and disappears at your full retirement age, and you'll get the money back. And if this content has been helpful, if you do me a favor, just click the subscribe button, hit the like button, share it with a friend. All those things help the algorithms, the overlords at Google or YouTube know that you enjoy this content, and it will go out to more people. And if you're nearing retirement, I have a video on 6 essential steps you should take before you retire, and you can watch it now.